Power 3 is accumulation, manipulation, distribution. Okay, that's the three components. The power aspect is, if you understand those relationships on what the daily range is doing, the open on a day that's bearish, okay, the open and anything above it, that is accumulation of shorts. Now, it's not limited to just open and above. That's where smart money and people like myself and my students, that's where we're aiming to enter getting short. The open to the high, whatever that range is, you take that range and you subtract it from the opening price. That is your opening range. That's where your fair value gaps, that's where your stop raids are going to happen, that's where your optimal trade entry is going to happen. Every potential shorting candidate, every premium array will reside and form in the range between the open and its high. In other words, if you're watching price and you're bearish, the day opens up and then it rallies up. That's a Judah swing. The range from the opening price up to that high, that range is what you project below the opening price. When I say opening range, that's opening range. So what that does is gives me an area at which to bracket out how much leeway I can give the market when it starts to go below the opening price and still take a favorable entry. Because power 3 is, I'm bearish, I'm expecting the market to open and rally above. If I can get something on short there, that's the ideal scenario. This is called close proximity entries. Having the opening range, when you're bearish, whatever the high is from the opening, project that down, your sell setups are going to form in that. That is accumulation of shorts. The manipulation is the initial rally up. That's the sucker play. That's typically the breakout artist thinking, oh, it's going to go higher. No, it only goes up just to go down. That's a fake run. Then it goes lower, creates the low of the day, and then closes near the low of the day. So between where the low of the day is and where it closes, that's distribution. What's being distributed? Smart money's short positions. So they're selling at the open and above or just below it, riding out the daily range. When it creates the low of the day, how do you know when the low of the day is formed? Well, I've taught you time references. So if price has been really taking a beating going lower and you're getting towards the end of the day, like 3:30, 3:45, something like that, it's probably really close to the low. Not all the time. Sometimes it creates a real fast, sudden continuation. And if you're not expecting it or if you're offside, it can be bad. But if it's on side, it's really fun to be a part of that. But generally, it's the last portion of the trading day, and it'll create some kind of a low, and then wherever it closes, between that low and where it closes, that's where the distribution cycle is occurring. That part is not that important. The main thing is understanding what does this candle have the highest probability in terms of forming? An open, rally, sell off, and close down on its low? Or is it likely to create an opening, trade lower first, then rally and close near the highs? Is this daily range more likely to expand higher or lower than the opening price? That's it. That's all you have to do. That's the key to bias. Now, how do you know what the bias is going to be most likely? Not everyday bias. Most likely, what's the bias going to be? Well, let's go back to this low over here. It creates a swing low. That means a low with a higher low to the right of it and a higher low to the left of it. So it's three candles that make up a swing low. Once you get a swing low or a swing high and you have the proper context and you know what you're looking for, that's it. You go in and you start hunting it. Now watch what happens. We have a swing low form. The very next candle, we have an opening. It trades way down and then comes back up and closes right near the highs. Is that the opposite of this candle? Yeah, but it's got a whole lot of movement below the opening price. So something just took place down here after this swing low was formed. Did this candle or bar go lower than that one? No. The rallying up on this candle here and closing on the high, that supports this as a swing low because it didn't take out the lower low right here in the middle. The next day, we have a big washout from the opening, trading down, and then it closes on the high. So the next day, we're likely to go what? Into this area here. Isn't that a fair value gap? Sure it is. What's the daily bias likely to be? Bullish. So that means it's going to do the opposite of this. It's going to open near the low and then rally and expand higher. Will it close on the high? I don't know. It could, but I don't need it to. I only need it to open and start to rally and get up in this area here. That's an opportunity. That's a trade. Does it do it? Yes. But now, when we trade it up into this area, look what happens. Next day, you might be expecting an open rally, close high. It doesn't give you that. So that could be a day where you missed an opportunity or you took a loss. No problem. Next trading day here, what are we seeing? We're seeing the market retrace back down into this run. How far can it go down? Well, look at your high down to your low. Equilibrium. It's probably going to go below equilibrium. To do what? To offer the market a discount. The market does what? It goes down below it, provides a discount. Once it gets there, our mind, or we're thinking, it's going to be the opposite of this. It's going to be the open near the low and expand higher. That's power 3. we have it right there. It opens near the low, rallies, and closes on the high. The next day, same thing. Opens on the low, rallies, and closes on the high. Now we've gone deeper into this area here, and in a small little range, but it's still the same function of Power 3. Accumulation, which is open near the low, trade down, and then close high on the daily range. Next candle, same thing. It opens, trades down, accumulates longs, trades higher. Same thing here. What's this? It opens, trades down, trades higher. Until we do what? We take out this short-term high. See that? Then we can get a retracement lower or consolidation. We get both. Small little retracement and consolidation. Next candle, Power 3 delivering for accumulation of longs. Next candle, consolidation. Might be a day you took a loss. Let's be real. Next candle, what's the bias? What are these over here? They're relative equal highs. There's stops resting above that. That's buy side liquidity. What's it drawing up to? We've already taken out this high. What's going to go up to here likely, right? Because we've already taken out sell stops below here with this drop, and we keep proving it's going higher. So where's it likely to go? Above here. So until we get to that point, we keep thinking the opposite of what we're showing here. An open near the low and close on the high. Power 3, accumulation of longs. Distribution of longs at the close. The next day, indecisive candle. Okay, no big deal. Next candle, we open, trade down. Same thing. We're looking for buys. The whole time we're looking for buys in here. You might get stopped out. You might have a losing trade, but you're not abandoning the bullish bias until we get above these highs. Then we have to study it. Does it want to run higher? Once it clears these highs, does it keep showing and want to go higher? Well, we had a nice run here. The next candle here, nice run here. Small little indecisive candle there, but then we go back in the same cycle again. It's expanding and it's accelerating higher. Each day, we're looking for longs. Opening near the low, trades below the opening a little bit, and then rallies and closes near the high. That's bias. That's sticking to your bias. And the same thing is done over here on the opposite. We had an imbalance here. Fair value gap, we trade up into it. So once we trade into it, what are we expecting? The market to do what? Trade back lower. So if we're trading back lower, we're going to be looking for this pattern. Open, rally, accumulation of shorts, distribution at the lows. What are they distributing? The short positions they've accumulated above or at the opening price. So in this candle, what do we have? We have the open, it rallies up to go short, and then trades down and closes on the low. Just like this is here. See that? The next candle, you're expecting the same thing. Does it deliver that? No. You might take a loss that day too. Okay, no big deal. It's likely to go where? Here's where the sell side is now. Each candle, open, rally, close down on the low. Open, rally, close down on the low. Open way back into this one, and then still closes lower than the open, but still nice range down. Same thing here. Opens, rallies, sells off. Next candle opens, sells off. Then comes back and overlaps it, and now we have a potential key reversal. Then we have back and forth price action where you can probably get beat up. Imbalance, it trades up into that, and then we go into that area where we're at now. So let's go to a candlestick, and it's a lot easier to see it this way. But this function of Power 3 is how I teach the bias, and I also teach how to submit to the daily range. You have to learn how to hold to the close. Think about what I've taught you so far in this teaching for Power 3. The accumulation, manipulation, and distribution cycle of the daily range. If we are trading near the high end of that fair value gap on the daily chart, that's what that level is, okay? When we just drop down to a lower time frame chart. So with this 15-minute time frame chart, the idea is we're expecting this Power 3 formation where it's open, rally, create the high of the day, sell off, and close near the low. That's what we're looking for. Why would that bias be expected on this day? Because we worked the upper end of that fair value gap on the daily chart. Then we had multiple shifts in market structure bearishly when we already have a bearish bias on the daily chart anyway. So it gives you a high probability that this day is going to be a down close day. It may not close on the low. It might just be a big down move, and that's all you need. You just need movement. So this level here, it's dashed. That's the midnight New York opening price. This is what I'm referring to when I'm looking at the opening or Power 3 on a daily chart. That price right there at midnight. Look what's occurring. That right there is equivalent to this little tick on this diagram here. It opens, it trades above the opening, just like that candle does on a daily chart. It opens and goes higher. You want to be selling short here. Why would you want to go short here? Well, it went back up in there and redelivered the down stroke on that paintbrush or roller on the wall. Well, now it's going back up. We're looking at the opening price here, and then we're expecting a sell to form. Well, here's that fair value gap. It rallies up into that. Isn't that a sell above the opening price? Yep. From that opening price to that high, that's the highest high. Take that range and subtract it from the opening price. That's about in this vicinity here, okay? Right in there. So what's occurring? Well, we have this sell here, then we have this sell here at the equities opening, and then we have this imbalance in here. So from this range high to that low, multiply that by 2 as a projection. In other words, whatever that low is to that high, that much lower you'll expect to see a short. And it forms right here.